What's up, everybody? Trey Bodwin here, and welcome to another great segment of Trey Finds Texas Autos or Trey Finds Cars. I'm still trying to figure out the name, admittedly. I'm super excited to jump into the topic of today, which will be finance, the finance department. Everybody's been asking me about it. We'll get into it here shortly. Let's go. So finance, the finance department, the place where everybody dreads. If you're listening wherever you are, Spotify, Apple Music, or however you get your podcasts, even on YouTube, let me tell you, this is probably one of the most exciting episodes you will hear, just because the finance department is a department that is somewhat of the heartbeat of the sales and variable ops portion of a dealership. This is what I mean. A dealership is broken down into two sides. You'll have your variable ops, which is your sales department, new and used, and of course the finance department, and then your fixed ops, which are going to be your service, your parts, and your parts distribution. So think of it, and also body shop to a certain degree. Think of it in the sense of how you would run any business, to where your initial sales are important, but the retention is also important. Variable ops definitely have to do with your initial sales. And then the service and parts department are what brings people back into the dealership to bring life and substantiability into the actual organization. So with that being said, let's talk about the finance department. Raise your hand if you love the finance department. Yeah, exactly. And as a previous finance director, and before that, I was a finance manager, let me tell you, it is one of the toughest jobs within a dealership. It's one of the toughest experiences on customers also. People hate it. Why do they hate it? Well, because they don't like being sold stuff. And also, traditionally, finance departments were the departments who would really just, figuratively speaking, of course, rip people's heads off financially. So we'll get into three topics today. One is the products that a finance department sells. Two is the rates that finance departments do not want to disclose. And how can you get the best rate? What are some of the things and experiences that I've ran into with it, both on a consumer side, but of course, as a previous finance director side as well. And then last but not least, we're going to do some defining terms here of the finance department to tell you what they cover and what they don't cover. And if I'm missing anything, let me know. I'd be happy to share that information with you. So let's go ahead and get started. Numero uno, defining the finance department. Well, F&I is finance and insurance, and that is the department that you go to right after you've agreed on terms with your salesperson or the sales manager to purchase your vehicle. So let's get really exotic today. I want to buy a Toyota Prius, and I decide when I buy that Prius that I'm going to pay cash for it. Well, a lot of times finance people would rather you finance, and the reason why is because they can make money off of the rate. And with the rate, there are two things. Now, I am going to get completely obliterated by the finance departments across the entire world. However, hey, I'm a fair guy, as I mentioned in episode 1. So if there's something that you want me to talk about and show value to the consumers, let me know. I'll drop a link below so we can talk. There's two things about rate, guys and gals. The finance department only likes to give you a sell rate. What is a sell rate? Well, the banks work indirectly with dealerships to provide interest rates. Based on your approval of your credit and a number of different factors, you will be given an approval. And that approval may be 3%, it may be 4%. Heck, in the state of Texas, it goes all the way up to 22.9 if I'm not mistaken. When you have an approval, you are going to more than likely be given the sell rate unless you have a nice finance manager. It shouldn't take that, but that's the truth. The sell rate is what you know, what is presented to you. However, here's where the golden nugget comes in, and please send your thanks. I would love to hear that I'm helping at least one person. The buy rate is what you really want, okay? The buy rate is what the sales people and the finance manager directly does not want to disclose. The buy rate is generally about 2 points lower than the sell rate. I'm going to say that again. The buy rate on average is about 2 points lower than the sell rate. Traditionally, if we went back a decade ago, I hadn't experienced this because I worked for some pretty, I would say, honest overall organizations. Buy rates could have been 4, 5, sometimes 6 and 7% lower than the sell rate. And you go back to the 80s, 90s, where things were really the Wild West. I'm not going to even go down that road. Those were just dark times, okay? So let's talk about this a little bit deeper. What do you do as a consumer if you're going into a dealership and you're looking to get a buy rate? How do you ask for that? Well, once you're presented the rate, you say, okay, is this the best you got? Finance manager or director, whoever says, yeah, based on your credit. And you're like, well, I hate to say it, but this isn't going to work. And they're going to say, what isn't going to work? You tell them the rate, especially if you have A+ credit. It's important to do your research ahead of time to actually know what automotive rates are going for at the time of your purchase. But generally, anything above a 720, you deserve the top tier rate, okay? So if you're not going with a captive lender, and captive lender is defined as the lender that works solely with that automaker. For instance, Ally was working with General Motors, and of course, Santander at some point was working with a lot of the Chrysler, Dodge, Jeep, Ram stores. Things change, obviously. When I was working with Ford and Mazda, of course, with Honda also. Honda was with Chase, Mazda was with Chase, and then it switched over to Toyota Motor Credit. Mazda did. So captive lenders are the lenders who actually work solely with that automotive brand, okay? So going back to what I said, if it's not a captive lender and you're just going for the lowest rate and somebody says, hey, Capital One is giving you 4% and you're a 720 score and everything else checks out, you don't have horrible DTI, which is debt to income, and you're a prime candidate for an auto loan, you can say, hey, listen, I can go to my own bank, I can go to my credit union and get a lower rate. And then you lead in after that and ask, what's your buy rate? And I guarantee you, mouths will drop, all right? Heads will roll. I like that song. I got to find that song and listen to it later today. The reason why is because this isn't common knowledge. Generally, they give you the sell rate because they want to make money off of marking the rate up. Now, as a finance person, I think that's kind of a shabby way, like a cheap and shabby way to sell. The reason why is because you want to sell product. Product is value. Rate, it's fluff. And also, a lot of these banks are stepping away from selling interest rate because it's an issue. People have been targeted, minorities have been targeted, and a lot of other groups, especially if they don't have great credit, have been taken advantage of with this buy rate versus sell rate thing. So a lot of lenders have gone to what they call a flat, which means that, hey, here's a little kickback to the dealership, not the finance manager, to the dealership for doing business with me. So with that being said, that is what buy rate versus sell rate is. That's why rates are such a scary thing because, you don't know if a finance manager is telling you the truth. So if you have questions about that, as I mentioned, I will be putting out a course specifically labeling how to handle the finance department in general. And then we'll go ahead and, of course, be a lot more granular about what you can do to make your experience a lot more pleasant. Now, let's go ahead and move on to products, okay? The products, there's a number of them. At the dealership that I work for, the automotive group, we had up to 12 at one point. And there's a difference. There's two differences here. One is there's groupings, right? So two groups. One is ancillary products, all right? Those are the products that are generally your front end products. So things like dent and ding, windshield paint protection, wheel and tire. I'll put an asterisk by that. windshield if I haven't said that already, and then theft deterrence, things like low jack, Spirion, vent etching, horrible. But these are just my experiences. I am agnostic. Okay, I am here to give you the experience, and then also from a automotive background, I am here to provide value. So a lot of times when I get salespeople watching this, at first they may be like, "Oh man, he's telling all the secrets," but I'm also creating value, and I'll explain why here. Let's stick to the ancillary products here for a little bit. These are going to be dependent on your driving habits, your driving style. So dent and ding, if you or your spouse or your kids are prone to getting a lot of dents and dings, this would be a value to you. Same thing with paint protection. I'm personally not a fan. I live in the Gulf Coast area, and I'll be frank with you, it's a lot of rain. It's a lot of, harsh things that go on with the weather. Living in a big city, it just comes with it. I just wash my car, and there's products nowadays where you could just kind of do this stuff yourself. I don't think it's worth it. That's my personal opinion. Take it or leave it. Nitro or wheel and tire, this is something that's a little bit different. Your wheel and tire is going to be, and you have to clarify with the individual that's selling it to you, your wheel and tire can be two things. It could be protecting against curb rash or scratches on the wheel or rim, and it could only be sidewall. Sometimes it does not cover things like your actual wear and tear on the tire. Okay, so I would suggest maybe looking into an actual tire warranty or coverage for that. You could get those from Pep Boys Discount or any local MTB shop, things of that nature. And then on the other end, you have non-ancillary products. Well, what are those? Those are your core products. Core products meaning your VSC, which is your service contract or extended service contract, maintenance, GAP, which stands for Guaranteed Asset Protection, and then your credit, life, and disability. I personally don't have a lot of experience with the credit, life, and disability because the organization that I worked for did not sell that. When I got there, they said, hey, it's not providing value to our customers. Let's leave it alone. So VSC, extended service contract. Let's talk about this. If you are an individual that says, hey, I drive my cars for a long time. I know that these things are more electric than they are motor. So I think it's some value for me to, have coverage if my ECM, my engine control module goes out, or, my touchscreen stops working. I want to have coverage. Look at the coverages closely. Make sure that they are actually going to cover what you're looking for. And then also find out what your coverage map looks like. If they're saying you are limited to that one dealership that you bought the car from, don't do it. Because you don't want to be limited to that. You're not going to always be in range of that place. Now, if they say, hey, man, you can go to any certified mechanic or certified technician, I believe the term was ASC, you can do that. All right. When you have coverage, it makes it a lot easier. And then look at your deductibles. All right. Some offer a zero deductible, $50, $100, $200, $250. It really just depends on what you're looking for. Most of the time, these are where, the products are marked up the most. But if you're buying a $50,000 vehicle or more, it's a value proposition, right? You want to make sure that you can protect your asset. Even if it's not an expensive car, if it's a $10,000, $15,000 car, it's really up to you. I'm personally not a fan of buying VSCs on dependable vehicles. Things like your Hondas, your Toyotas. I drove Mazdas for a long time, and I would always stick to the coverage that comes on the car, 3 or 36, just because the cars are so great. I've also been lucky not to have any experience where, something has gone out. So once again, I'm just giving you my personal opinion and the experience that I have here for nearly a decade. And then gap protection. That's going to be probably one that you want to place priority on depending on your situation. Now, if you have a lot of equity into the vehicle, meaning that if you bought the vehicle with a large down payment, or you're trading in a vehicle that serves as a lot of down payment going towards the new car, you may not need gap. But in most cases, if you're only putting down, a couple grand and, let's say for numbers sake, you're putting 3,000 down on a $20,000 ride, gap may be important for you, especially if you live in places that are prone to natural disasters. In Texas, there's tornadoes, there's floods, in California, there's earthquakes. I don't know the percentage of those natural disasters, but I do know that gap insurance protects you in covering the difference that your own car insurance won't. So here's a picture for you. Imagine that you are in a flood, God forbid, but you have to abandon your car on the side of the road because there's nowhere else for you to drive. Well, what happens generally, since a car depreciates, there's the value of the car and then there's the actual amount that you still owe on the loan. Gap, ding, 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 is going to cover that, right? So your guaranteed asset protection is going to cover the difference between the amount that you owe on the car and the actual value of the car. So if your insurance is not already doing that, get gap protection, look into it. And if you have questions, hit me up. Now, last but not least, before we close it out, maintenance. This has been a big topic also. Traditionally, your manufacturers, some, not all, will provide your first 2-3 years of maintenance, maybe even one. Some dealerships have done it as a retention tool to bring customers back in and to do business with them. I personally say, hey, look at how much it costs to do maintenance on your car. If you're buying a Highline car, Highline vehicle, Mercedes, BMW, Audi, maybe it makes sense for you to go ahead and get a maintenance package. But if you're buying, a Chevy Malibu or, a Chrysler 300, it may not be that expensive to just pay for that stuff out of pocket. Everything is relative depending on what you're looking to do, how you're looking to drive the car. Of course, your term and your mileage is what everything is going to be based on. But I will suggest, if you are buying a Highline vehicle, to go ahead and look into the maintenance package. That's all. And that's all the time I have for today. I didn't even get a chance to do a coffee break because I was just on a roll for you guys. I'm so excited to share more content. If you have any other questions, just let me know. TreyFindsTx.com. Go ahead and hit that link that says automotive, and I will be happy to help you. Send your questions there. And of course, we have pricing listed, and I will be able to send that to you. If you send a request, I'll be able to shoot you pricing just in case you wanted to, have a little consultation on how to buy your first car, second car, third car, what car to buy. Is this the time to buy? Because we are coming off of a 2020 year, and in 2021, there's still not a lot of cars on the lot. All right. So as always, have a great day. Can't wait to talk to you next time.